Hello, it's ChewDog Charts, and perhaps you've heard this before. Yea, though I walk through the valley of the shadow of death, I will fear no evil, for you are with me. Perhaps that's a bit dramatic, but we did have nearly a 666-point decline in the Dow. So on Friday, how did you react to that decline? Was it nothing to you? Were you concerned? Or are you looking forward to more declines? I have one guarantee for you. It ain't over. Now, in the short term, there may be some more volatility because Friday, the Federal Reserve imposed regulatory restrictions on Wells Fargo, which prohibits Wells from further growth until Wells sufficiently improves its governance and controls. On the other hand, is this the beginning of the next major market correction? Probably not. There's just simply too much exuberance currently in the market. And it's going to take several failed rally attempts to begin to erode that base of bullishness. But therein lies exactly what you want to look for. Rallies that fail at previous resistance levels, rising volatility, and declining rates of participation by investors. At previous market correction in history, investors were always given multiple warnings before the crash actually occurred. On another note, I know I have some requests to take a look at some stocks, Snow Spiral, and I'll get to them. But sometimes things in the market happen that are important and need to be addressed, just like bonds. And I sensed last week that changes in the bond market may impact stocks, so that's why I gave you a heavy dose of bonds. Today, I'm going to show you a few charts, but really, my goal is simply for you to understand that we should be prepared and look forward to this volatility, as these are the conditions that present opportunities for us as investors. So let's take a look. I do realize that I feed you a steady diet of charts showing how overvalued the stock market is. However, those are simply the conditions of the day. And when that changes, either we'll know in advance or we'll be able to follow that relatively closely. And this chart here, which is the S&P 500 price to sales, shows that our current level is very elevated, as high as it's been since, say, the year 2000, right before the dot-com crash. This chart is also useful that it shows that the topping process can take several months, maybe several quarters. And that process, there is lots of volatility, such as we experienced yesterday, Friday, with a near 666-point decline in the market. Now, we will have a bounce back in the market, as that process typically occurs over a longer period of time. So we're just going to watch to see if this actually is the beginning of the topping process. And my goal in creating this channel is to assist you in understanding how to avoid any mistakes, because when the market correction, bear market, or crash does occur, you'll have the patience and the money to take advantage of those opportunities for some pretty rich rewards. So be patient and stick with me. Let's go to the next chart. This chart here shows the cash balance as a percentage of the S&P 500 market cap, and showing you that the current level is relatively low. The market can only go up when there's more fuel or cash. And this chart shows you that the level that we're at, we have to go back to the year 2000 before we find other levels that were similar. And of course, that coincides again with the dot-com crash. So right now, cash balances are low. You, as investors, you need to start building your cash levels. Let's go to the next chart. And this chart here, which shows the aggregate number of shorts in cash equities. And the current level, again, is relatively low. You need to go back to the 2006 timeframe to find similar levels. Now, what this chart says, essentially, is that with the low level of shorts, most investors, institutional and otherwise, are simply betting that the market's going to go higher. However, this works as a contrarian indicator. When the levels are low of shorting activity, that may portend a turn in the market. And Friday was a good sample showing the possibility of a turn in the market. So we'll keep our eye on these contrarian indicators as well as the overall market itself. So let's go to the next chart. And this chart here dovetails very well with the chart showing the relative low levels of cash. And this, which is the net margin debt as a percent of the S&P 500, and we've seen various forms of this chart before, but it shows that we're at a record high. And going back, we see a relative high in about June of 2006, right before the great financial crisis, and another record high at that time in about June 2000, right before the dot-com crash. So with Friday's near 666 point decline, the question becomes, well, who's going to get a margin call coming next week? And that may provide another source of volatility. And this chart is an update on the Bank of America Merrill Lynch bull bear indicator. The last time I showed this to you, the level was 7.9. Now, mid last week, we hit 8.6 on the bull bear indicator right before the sell-off on Friday. So this is another indication showing that we are extremely bullish. Again, these sort of things portend changes in the market. And so if I've achieved my goal is to show you that we don't need to fear market volatility. We should look forward to it. And those who fear market volatility are likely watching other YouTube financial channels and not this one. So for now, that's ChewDog Charts. Thank you.